Many people think options trading is all about predicting the direction. Wrong. Options trading is all about identifying and playing within the range. Many people think options trading is all about making huge money.
Yes!
It is right and wrong as well. It is right because options trading is all about making huge money. It is wrong because options trading is all about making huge money not in a quick time but in the long run. In this video, I will explain two option strategies to make constant returns every month. In addition, I will also explain how to do backtesting for these two strategies, and I will also show the backtesting results for these two strategies for few years. So without wasting much time, let's start. A short strangle strategy is like, I don't think this stock is going anywhere. So you sell slightly OTM call option and put option, hoping the stock will stay within the range. So if it stay within the range, you keep the premium from selling both the call option and put option. So in simple words, iron condor is short strangle plus protective hedge to prevent the unlimited losses. So I will explain these two strategies in detail going forward. For example, let's say Reliance current market price is 2500. This is just for an example, okay? So the Reliance current market price is around 2500. Now you think in this month it will not go above 2600. At the same time, you will also think it will not go below 2400. So in simple words, you are predicting though the Reliance will stay within this range 2400 to 2600. It will not break above 2600. It will not break below 2400. That's what your traditional your technical analysis or your some understanding says about this. Now what you can do is you can sell 2600 call option at 12 rupees. At the same time, you can also sell 2400 put option at 12 rupees. Once again, this is just for an example sake, okay? So you can sell 2600 CE at 12, 2400 PE at 12. Now if Reliance stays within this range, okay, if it stays within this range and expires, within this range by end of month, you pocket 24 points, right? That is the profit because this 12 rupees will goes to zero. This 12 rupees will goes to zero and your profit will be 24 points into whatever the lot size. That is your overall profit, right? Now, this is another example. This is Infosys. So currently Infosys trading somewhere in this range, 1791. So now you think Infosys will not go above 2000 rupees and at the same time Infosys will not go below 1700 rupees by end of this month. That's what your analysis or understanding says. So now what you can do is you can sell 1700 call option, put option, and you can sell 2000 call option, and if the new Infosys stays within this range, whatever this premium becomes zero, this premium zero, and whatever the overall profit you make it. Now this is a simple payoff chart for this Infosys trade. For example, if you sell Infosys 27th March 2000 CE at 3.3 and 27 March same expiry 1700 PE at 15.1. Okay, so now if you observe very carefully, the profit comes around 7360, which is close to 6.65%. This is the ROI, and the margin required to execute this strategy is around this much, 1,10,000 rupees. Now you need to observe very, very carefully. The probability of profit is 78.4%. It means, out of 100 trades, if you take similar trades like this, out of 100 trades, 78 trades will become success, right? So in this case, the success probability in this case is 78.4%. Okay. So there are some ways we can increase this probability of profit by doing this. Okay. There are two things are very, very important in options trading: probability of profit and ROI. In this case, the probability of profit is 78%. ROI is 6.65%. Okay. Now, if I do little adjustment, a little, if I take different strike prices, it will vary. For example, if you see here, in this case, the probability of profit is 94.6% and ROI comes down, right? So what I did is I expanded the range. Okay. Earlier it was a small range. So earlier it was 2000 CE. I just pushed CE by 100 points. Okay. Now the premium reduced in this case and I pushed put option by down by 100 points. So earlier it was 1700 PE, now it is 1600 PE. So by doing this, what I did is I increased the probability of profit. Now it is close to 95%. Earlier it was around 85 or 86%, right? And by doing this, I have reduced the ROI because you can't get a trade in which the ROI is very high, the probability profit is also very high. Okay, you need to strike a balance between these two. If you increase this, this will come down. If you increase this, this will come down. So you need to strike a balance. So here, what I did is by pushing the range, there is a high probability of price within staying within the range, right? That's why the probability of profit increased. At the same time, by stretching the strike prices by 100 points, the premium will come down, right? That's why ROI also came down in this case. I hope now the short triangle strategy is clear, but there is a slight problem with the short triangle strategy. The problem is this: unlimited risk. If you see here, the maximum loss is unlimited risk because this will be your break even point. Your loss starts below 1594, and at the same time your loss starts when the price started trading above 2106. So this is a problem with uh, Infosys chart. If the price goes below this or it goes above like this, however, there is a less probability. You see, the probability is very, very less. Even if it comes here, you might make little profit or you might lose very little money or sometimes break even also. But there is a chance because theoretically or even in market anything can happen. So in this case, we need to prevent this. So how we can prevent this is if you buy a put option at this strike price and if you buy a call option at this strike price, this removes the unlimited scenario, right? Because if the price, suppose let's say you bought put option at this level, if the price starts going below this level, the put option, the bought put option premium starts increases, right? So that's why it removes the unlimited scenario on the downside. At the same time, if you buy a call option here, if the price starts going above this level, this premium starts increasing, right? So this removes the unlimited loss scenario on the upside. For example, see here in this case, I bought around in this case around 2100 CE call option. I bought around 1.5 and 1560 PE I bought by paying 3 rupees. So in this case, there is no unlimited loss. You see here, the maximum loss is only this much. Don't worry, you don't have to face this kind of maximum loss every time. This can happen very, very rarely, and most of the times it will not happen based on the strike price you choose. I'm going to explain that part even in the backtesting part. Now, if you see this compared to the short triangle, here we don't have the unlimited loss scenario, right? On upside and downside as well. So this is called as iron condor. Okay, there is a simple difference. So short triangle is only two sold legs, two OTM sold legs, call option, put option, whereas iron condor is short triangle plus two protective hedge legs, which is nothing but bought options. So iron condor is the safest one compared to short strangle because it removes the unlimited loss scenario. At the same time, it reduces the margin requirement. Earlier it was around 1 lakh 10,000 something. Now it reduces the margin. It also reduces the ROI a little bit because we will be taking two extra leg, right? This premium reduces the ROI. However, we can take little extra position because the margin requirement came down because we have removed the unlimited loss scenario, right? So this is This is how it works, iron condor. For example, this is the current market price. This is the sold leg, call option, put option. This is the bought leg, call option, put option. For example, here you sold at 12 rupees. See, you sold at 12 rupees here. You bought hedge at -2. You bought minus 2. So if the price expires within this range, you make 12 plus 12, 24 rupees from these two legs, but you lose 4 rupees from these two legs. So in that case, your overall profit will be 20 points into the lot size. I hope this is very clear now. Now we will go to the live charts and the backtesting part and the analysis part in the live market. This is one more example. You can see this is Infosys. This is Nifty. This is the sold leg. This is the sold leg. This is the buy leg. This is the bought leg. So usually iron condor look like this. So here the probability of profit is less because the range is also less. If you start increasing the range, probability of profit starts increasing, but ROI starts to come down. Okay. So now we will go to the live chart. For example, I will go here. I will go to TCS. So this is TCS daily chart. I will go to monthly chart. So the idea is, I will remove these two lines. The idea is TCS will not make 10% move. In fact, TCS or any other good stock or any other major stock will not move 10% in a month. That is the overall assumption. Even if it makes 10% more, there is a possibility of making profit by making small adjustment, which I'm going to explain. I will do some back testing for these months so that you will understand it in a better way. So what I do is I will go to, this is an Opstra Definite platform. I go here, I will go to option simulator. For example, I will go to TCS. I will go to TCS. I will go to TCS. So I'll check for the current month. Now, today is 24th Feb. I'll check for Feb month first. So 27th Feb. Start date is expiry of Jan, previous month. Payoff date is today, 24th of Feb. Now, so what we do is we initiate the strategy around 10 o'clock, okay? Not at the market open, because around 9:15 the market will be little volatile. So around 9:50, 10 o'clock, okay? So what we do is 10%. For example, let's say Infosys current market prices, TCS current market price is 3,700. So approximately 300 points away is, which comes around 10%. So what I do is I will look for 300 points away, call option, 300 points away, put option, I will sell it, okay? So I'll get to option chain. So 3,700. See here, approximately I will sell this. The premium is around 7 rupees. Call option also I will see around 10 rupees. Okay. See, if you see here, okay. So this is a short straddle strategy. First, what I'm going to do is I'll explain short straddle strategy for a couple of months for few stocks. Then I will explain iron condor strategy for a couple of stocks for few months. Okay. So now see here, this is the price here. When it comes here, for example, this is close to, you can see here, right? When it comes here, it is close to 10% more, right? So which means the when we are taking the trade, the price is here. If it moves close to 12% up downside, then only we starts to lose money. If it goes here, then only we starts to lose money, right? So approximately the capital requirement for this is 1 lakh rupees. So you make around 3% returns in a month. So if you bring this upside, little bit upside, you make little extra ROI, but it decreases the probability of profit, and it little increases the risk. Okay. So now if you check properly, so instead of going 50 minutes, 30 minutes, I will go for 1 day. So see here, the date will change here. So the profit started 288 rupees, 1000 rupees, 1500, 2000. See, if you're happy with 2% returns, you can close the trade. Okay. See, this is how it works. 2200 rupees, 2170, 2310. See, 2.4. So which means if you have taken that trade, the short strangle trade, you had already made 2400 rupees, which means 2.5% returns by within 10-12 days actually. So if I'll continue for the sake of continuation, because the maximum profit you can make only is 3000 rupees. Two 2283. It reached 24th Feb. Today is 24th Feb. So there is a profit like this. So what I do is I will go to the previous month. For example, I will go to 30th Jan. Start date will be the last expiry of December. Payoff date will be the January. Okay. So now what I do is I will start around 10 o'clock, 9:15, 9:55, 10 o'clock. So 10 o'clock, I will go to option chain. So I'll pick somewhere around this, put option side, I will sell it. Call option side, I will look for a premium around 10 rupees. Okay. Call LTP is here. Okay. Somewhere here, this is fine. I will sell this. You can see this is a short strangle strategy. The price is here. If it moves around 9%, then only I start to lose money. And if it moves around 8%, okay, then only I start to lose money. So now if I will approximately 3.9%, because the capital requirement is around 1 lakh rupees. So there is a probability of, the ROI is 3.9 maximum ROI. So I will check day by day. First day slight profit, second day profit, little loss, minus 1365, because it came down in a drastic way. Minus 1365, minus 480, minus 105, minus 630, minus 358, minus 3900. See, this is where you need to be little careful, and you should have a adjustment plan, which I'm going to explain in the next video actually. So we'll go further. 2400, 560. See, 1600 profit, 1600, close to 2000. 2152. See, now if you're getting 2% returns, you can always close and exit the trade. I suggest 2% returns in a month is decent. If I go further, 2300, 2500, 2600, 3000, 3% returns is very good, but still I proceed. So generally I suggest if you get 3% returns, definitely book it and close the trade. No need to hold the trade. To 3300, 3500. Next week, this is the last week of the expiry. 3500, 3500, 3700. I think it's done. Okay, it is done. See, it made around 3893.8% ROI. So similarly, I will go for one more month, probably not December, October, 31st October. Start date will be September, last Thursday. Payoff date will be October 31st. So I will go around 10 o'clock. I will get the option chain. I will see around 9, 10. This is fine. This 16 is little extra, little risky. So I will sell this. Call side, you can take little extra because there is a less probability of going upside, because market can fall in quick time, but upside is less probability. So I can select this. Now see here, if the price moves here till 11%, I don't lose money. Till here 11%, I don't lose money. Upside, I can take little bit extra risk because 11% is too much. So I can take little extra risk. So I'm just explaining all these things so that you can understand the ROI and the probability of it. Now the ROI is 3.9%, right? See, after doing little adjustment, the ROI will increases now. So what I do is I will click this 4800 CE instead of 4800 CE. I will sell 4900 CE. This increases, sorry, 4700 CE or 750 is also fine. See, it increases the ROI 4.4%. Now from here, it is around 10%. So 10% is very good. So if I get ROI 4.6, this is really good. So you can check this. If I go further, small loss, small profit, 1000 profit, 1.3 profit, 1.4 profit, 1.4, 1.2, 9th October, 1.8. See, 3% returns already done. So my suggestion is, if you whenever you get a 3% returns, always exit and close the trade. No need to hold more than that. 3.5, 3.6, 3.5, 3.7, 3.7, 4,000. So which means 4% ROI. 3.8, 3.7, 3.7. I think we came very close. One more week is there. 4.2, Tuesday 29, 30th October, 4.4, last day. So last day is 4.4. So we made around 4.4 ROI. So this is how you can do with a short strangle strategy. So now I will explain. I will go through the iron condor. Similar thing. For example, I will reset. So what I do is I will go to TCS. Probably I can go to some other stock as well. But I will explain for TCS, then I will go to some other stock. So for TCS, what I do is, again, I will go with the recent thing first. 27th Feb is the expiry. So Jan is the last Thursday is the thing. 27th Feb is the payoff date. So now again, I will start at 10 o'clock. 10 o'clock, I'll go to option chain. So what I do is, I think this is 11.4 is little tricky. 6.75 is fine. I will select this, add position. I will go here. I will look at LTP around 10, 11. Okay, 10 is fine. I will select this. You can see here. From here, if it goes upside 10%, then only I start to lose money. If I go here around 11.5%, then only lose money. So this is fine. The maximum ROI is only 3,000 rupees. So this is fine. If I go further, okay, this is iron condor. So I need to add the buying leg as well. So what I do is I will look for a premium, little bit lesser, okay, for both the call option and put option. I think this is okay, there is one thing here. So what I do is here, because there is only one leg here, instead of 6.75, I will opt for this 11.4. So in this case, 3600 PE, I will come little bit above 3600, 3550 PE. Sorry, 650. 650 PE is 9.45. I will change this. Then this is fine, 10.85, okay. So now what we need to do is we need to add the buying leg, hedge leg for the iron condor. So this is 4.4, this is fine. I will buy it. And for call side, this is fine, 2.75. See, if you see this is the iron condor actually, okay. So upside loss is higher, that's okay, that's no problem, because there is a less probability of price going on the upside. So we can go with a little small premium hedge on the upside, that's not a problem. See here in this case, in this case, the margin requirement usually less compared to the short strangle. There is no unlimited loss scenario. Here in this case, 2.3K is the profit, maximum profit we can generate using the iron condor. But this provides little extra safety compared to the short strangle. If I go further, 341, 805, 1146, 1671, 1837, 1863, 1986, close to 2000. So which means 2% ROI. Whenever you get 2 to 3% ROI, you can plan to exit. In this case, definitely you can exit because the maximum profit you can make only 2300. So when you are making 2000 rupees profit, there is no need to hold the trade for another 20 days to get 300 rupees, right? It doesn't make any sense to me. So you can always exit this trade and you can look for some other trade, maybe in weekly options or bi-weekly options in Nifty or some other thing with the same strategy. But for the explanation sake, I'm going to continue here. 2091, 1785, 1855, 1785, 1898, 2065, 1601, 936, 1785. I think okay, so today is the last day. So I mean, still we have some more days for the expiry, but for the calendar sec, today is the last day. So we got only this much of money. So I will go to previous month. I will go to 30th Jan. Start date will be December last Thursday. Payoff date will be January 30th. I'll go for 9:15. I mean 10 o'clock. See 10 o'clock, I will look for option chain. Up 10 is enough. Put option, call option now. Around call option, I can take little extra risk. I think this is fine. See here, with start strangle around 3.9. Here close to 9%. Here close to 8% is fine. 9% is fine. So I need to add the hedge leg, right? So hedge leg is this, buy. I will go here, edge leg is this, I will buy here. If you see here, this is how it looks. So 2.7 is the RY, 2.7, around 2.5 or 2.6 is the RY. So I'll go further, one by day, 227 rupees, 330, minus 1000 rupees, minus 490, minus 183, minus 551, minus 500, minus 2861. See here, this is where these kind of days will be little tricky. So what you can do is you can have a stop loss level. For example, you are making around 2700 rupees from this strategy, right? So you should not lose more than this amount. For example, maybe 2800, or if you are okay to take little extra loss, because anyway these strategies will give more profit, right, in the long run, more number of trades. So you can keep stop loss at double. For example, 2700, maybe 5200 or 5000. If whenever the loss shows 5000 rupees, you immediately close the trade. That's how you can exit the trade. Let's say, let's assume, for example, in this case, your stop losses level is around maybe 3000 rupees. If you will exit if it exceeds 3000 rupees, or you will hold the trade. That's how we can manage actually. See, it didn't hit the stop loss, right? 1846. So now you're still holding. Now it came to profit, 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 2000 profit, 2% ROI. So you can always plan to exit 2000, 2300 or close to 400, 2500. So 2.5 ROI. Now you can definitely exit, right? Because after this, one more week is there. You get only 200 rupees even if you hold the trade. So at this point of time, definitely you can plan to exit, but still I will continue for the sake of continuation here. 2485, 2511, last day done, 2773. Okay. So this is how it works, iron condor. For example, now I will check for Nifty. Usually Nifty are volatile. Usually Nifty and Bank Nifty are volatile. You need to pick good stocks which doesn't move much either on the upside or downside, like TCS or Infosys or Hindu Unilever, stocks like that. For example, I will check for Infosys. I'll check for Infosys. I will check the iron condor only. Okay. For example, see here in Infosys, what happened was, see, Infosys fell very much, right, in this case. Okay, we will see what happened in current month. This is a monthly chart. This is a current month. Okay, so we will see Infosys for the current month, which means 27th Feb 25. Start date is January last Thursday. Payoff date is February 27th. Now 10 o'clock, get option chain. Put LTP, we don't have comfortable LTP. We don't have around 10 rupees, 12 rupees, 15 rupees is little extra risk. 4.2 is very less premium and we don't get an hedging leg. So I will select this without any other option. In real market scenario, probably I would have avoided this trade. But for an explanation, I will continue here. I will sell this. Then I will buy this. I will sell first call option, maybe around 14. Then I will hedge this leg. I will hedge leg on the call side. This is enough. Now if you see this, around 9.140 is the profit. I'm not sure how much margin is required for Infosys because this looks little higher side. But anyway, I will continue. We can check that. For example, if you go to Sensible, we can check how much margin is required for that. So if you go to Sensible, if you go to charts, if you go to neutral, iron condor is somewhere here, short iron condor is here. So it selected the 4 leg. So approximate margin required is close to 1 lakh only, 85,000. So close to 1 lakh, which means, so this trade is really attractive, around 9% ROI. This is really good if provided if price close stays here. See here, this is little extra risky because around 7-8% our last starts here also 7-8%. Earlier I used to sell 10%, right? Here I bring down the margin by 2% on the upside, 2% on the downside. That's why we are getting little extra ROI. This increases the little extra risk, but anyway, we will see how it works. I'm showing this because we didn't had an extra leg on the downside. Okay, that's why I'm showing this. Otherwise, usually I will take somewhere here. Okay, little profit, 1,000, 3,000 profit on second day. I would say take it and book it and close it. 3,800, 4,400, which means 4.5% ROI, 4.7%, 5,000. I think this is a better deal. Anybody can take this kind of ROI and they can exit. But I will continue for the explanation sake here. 6,000, 6,600, 6,400, 7,000. I think within 15 days we are getting 7.2% ROI. We can definitely exit, right? I'll continue here. 7,500, 7,300, 7,780, 7,980, 7,920, 8,000, 8% ROI. I think we came the last, 24th Feb. See, Infosys fell around very much, right? Infosys fell very much here, right? But still, this iron condor strategy is making profit, right? It's making profit. So this is the power of this short strangle and iron condor. See, iron condor is properly safety one because it removes the unlimited loss scenario on the upside and downside, and hence there is a high possibility of making profit in iron condor as well as in short strangle also. But if you're little risk oriented player, they can plan with short strangle because it reduces the transaction cost because you don't take 2 extra legs. But you should ensure the range is definitely 10% on the upside, 10% on the downside. Whereas if you go for iron condor, you can reduce the percentage maybe by 8%, 9%, but you have to opt for the edge. It increases the transaction cost. However, it reduces the margin so that you can take more position. So this is how one can use both the short straddle or short strangle or iron condor to make constant returns every month. I hope this video is really helpful, friends. If yes, please like the content. You can subscribe to my channel and share this video with your friends. So I will see you in the next video with another useful content. Until then, thank you. See you. Bye-bye.